Good afternoon, everyone, and welcome. We are glad to have you with us for another BLD summer webinar, How the 2025 Tax Law Impacts Your Profitability and Business Valuation. For those of you that I haven't had a chance to meet, my name is Cody Nuremberg. I am the president of BLD Connection, and I will be introducing our speaker for the session and monitoring the Q&A, popping in and out when those questions do come through. Before we get started, I do want to take a minute to thank our sponsor once again for sponsoring our summer webinar series again this year, and that sponsor is LBM Advantage. LBM Advantage is one of the nation's largest member-owned buying cooperatives, serving independent lumber and building material dealers. By combining the purchasing power of more than 500 dealers and 1,500 locations across the country, LBM Advantage helps members secure competitive pricing and access to hundreds of manufacturers and suppliers. In addition to the buying power, the co-op provides market intelligence, product sourcing support, industry expertise, and business programs, helping independent dealers strengthen profitability while maintaining their independence. So once again, we are very grateful to our friends at LBM Advantage for their support of our BLD summer webinar series and all of our programs and events. With that, Sam, once again, welcome to our summer webinar series. Good to see you again, my friend, and you are welcome to take it away.
Excellent. Thank you, Cody. Appreciate it. Appreciate the nice introduction. Thanks to everybody for showing up, and put in an additional plug here. Thank you to LBM Advantage for sponsoring this summer webinar series. I think that's great. All the knowledge that comes out of this is really important. So Sam Brownell, Stratus Business Advisors is the company. We do work all across the country with LBM dealers as well as a number of other different industries and independent businesses with the goal of trying to keep independents independent. That's our driving force, our driving motivation. And so, as many of you are aware, we just came up on the 1-year anniversary of the tax law, right? The One Big Beautiful Bill Act was passed last July 4th, 2025, and includes a number of different changes, updates, clarifications to various tax rules and regulations. We're going to talk through those today, as well as how they can help your business and how you can really focus on some of these to improve cash flow, improve profitability. Those things ultimately will drive business valuation, which then helps with net worth and estate and intergenerational wealth. So all of this stuff is connected, and we will talk through all of that. So first, a quick disclaimer here. We are consultants. We are very knowledgeable about tax law, but we are not CPAs. We are not tax attorneys. So what we're telling you here are strategy-based, but we would encourage everybody to please focus. And if you do have something, you're welcome to ask us a question, but definitely your CPA in particular is the right place to turn. So, as I said up top, broad impact. We're going to focus on 8 areas today. And these are the 8 areas that we're going to focus on, and we're going to dive into each one of them. And then we're going to talk a little bit about how this impacts you. Some of them will impact you on a personal side, some of them will impact the business side, and some of them will go between the two, right? A little bit here and a little bit there, and we may be able to use them on both sides. Some of these are going to be more specific to the business owner or the executives. Others may be more for your rank and file workers, but each one of them can be used to really help your business grow, to help you improve cash flow. So before we jump in, I just wanted to do a quick poll question, which should be coming up. I believe that when we tested it, it came through on the chat. So, but really just wanted to get an idea of where people are with understanding this bill and trying to implement some of the strategies that came out of it. And so take a quick look here. Hopefully it won't be too hard of a question to answer. I'll give everybody 20-30 seconds here. Excellent. See some responses coming in. Appreciate it, everybody. Looks like a lot of folks who have responded. The majority of you are filing about the same as you did last year. Totally understandable. There's a lot to digest here. Some folks have reviewed scenarios or even spent some additional time thinking through this. I think that's great, but wherever you stand, the whole idea here is that we're getting a little bit more knowledge, and every year we can figure out how this bill fits in a little bit better with our business and the strategies that we want to implement. So without further ado, let's jump in here. So income tax rates. So currently 7 brackets. What this did was it kept the top marginal rate at 37%, right? There was a big question about that, is where tax rates were going to go. It has actually widened some of the tax brackets, particularly the 2 or 3 right underneath that top marginal rate, which is a good thing, meaning that more income fits into lower tax brackets. So that's a really good thing for everybody. And just to keep in mind, depending on where you sit in the organization and who you interact with on a day-to-day basis, some of us might be itemizers, some of us might use a standard deduction, but that standard deduction was increased again. The numbers you see here, the 15,750, that's for an individual, a single filer. The 31,500 is just doubling that, right? That's your married filing jointly. So depending on where you sit in the organization or who you talk to, this could be a great thing to discuss, right? It's for most people nowadays who are your rank and file employees, that standard deduction is going to be what they use. It's nicer, it's higher. So this can be a good way to get folks in the company knowledgeable, right? What is going on? How can you help them, right? That makes for a more engaged workforce if they know that the company is actually looking out for them. So a couple things to think about there. And then there's going to be an inflation adjustment, right? That's a good thing, because as prices go up over time, and we've all seen this right over the past 5-6 years, these tax brackets are going to adjust. Now, it's probably, if you're right on the margin, it's probably not going to make a huge difference, but it is nice that they are adjusted with inflation. So what do you do now? What can you be thinking about? S Corp LLC, right? Partnership type setups. Right? This is where income is coming directly through to us, right? We're pass-through entities. So can we place new equipment into service? Can we take advantage of some of this new expanded brackets to be able to lower and reduce our taxable income, right? As owners of those companies. Remember, there's no change at all in C corporation. C corporation rates stayed at 21%. That's where they have been since the 2017 tax law. So a couple other things to think about here, one from a business / personal side, and the other one from a personal side. And that is this idea of cash balance plans, right? A cash balance plan is in addition to a 401k or whatever type of defined contribution plan you have right now. This can be a way for owners, executives to stick away a lot more money into a tax deferred vehicle than they can through a 401k plan. And this can be used in conjunction with to really juice up savings here. But the nice thing is contributions to a cash balance plan are going to come from the employer. They're going to be tax deductible. They're going to grow in a tax deferred manner. Right? And this is more of a defined benefit type plan, right? Where you're going to have to incur a little cost here on the actuarial side, but it can be a really good way for you to take profits that otherwise would go to taxes and put them into accounts for yourself as an owner or your key people. And then you'll have to balance that out with some of your lower compensated employees. But this can be a really good way to redirect money from the company to the people that you want to incentivize, as opposed to paying taxes on it. The other thing to think about here too is, depending on where you sit in these tax brackets, is this idea of Roth conversions, right? Can I convert $20,000, $30,000 without bumping into a higher marginal tax bracket? Pay taxes now, don't pay taxes later, don't have required minimum distributions down the line. These are all good planning things to think about, especially as we look at the long-term tax landscape. Rates are low historically right now. My guess is that they're going to go up. They're going to have to go up at some point. All you have to do is look at the debt and the deficit. And so it may be worth it to pay some taxes now so that we get ahead of this. Now, this was a big one, particularly if you live in a state that has higher state tax rates, higher property tax rates. Remember back in 2017, they put a cap. One of the ways that they got that 2017 tax law through Congress was it had to be revenue neutral, right? That's the whole idea behind this reconciliation. Well, to do that, they really reduced the amount of deduction that they were going to allow people to take for state and local taxes, right? Which includes property taxes. They put a cap. It was capped at $10,000. Well, this bill, at least for the next 4 years, increases that cap by about fourfold, and then it'll go up every year with a 1% adjustment. But this is a way that, combined with the fact that they have not limited the pass-through entity tax, right? This was a big one. For those of you who are S corporation owners in a partnership, you are probably intimately aware with this, right? This was the 36 states out there, and primarily states that have state income taxes, but they went ahead, and this includes, by the way, most of the BLD member states here that were passing these laws. This allows you, instead of having to pay these taxes as an individual, pay it at the business level and take a deduction. That can be a pretty powerful thing. So think about it. I'm sure a lot of you have discussed this with your accountants. Pay those state and local taxes through the business. I think that's number one, right? It's a great way for you to get a kickback, right? Because then on your personal income tax return, you can claim that deduction, right? If you paid $25,000 of state and local taxes through the business, you can take that $25,000 as a credit on your income tax, and that can be a really good way to balance out what you're doing here. All right. Thinking through the timing of tax payments is going to be important, right? We know that as of right now, as we saw in that last slide, and I'll go back there for just a second, 2030, the cap reverts. It goes back to that 10,000 level. So as we are moving forward, are there ways, particularly as we get into 28, 29, that we can pull some of those tax payments from future years forward? Well, I'm going to put an extra 10,000 towards my state taxes the next year, right? Use the fact that that 40,000 change amount is going to be reduced. See if you can do stuff. Talk to your accountant. Are there strategies you can use? All right. And then for those of you who are a higher income, potentially have some other types of deductions in there we can talk about a little bit later. And if you're in a high tax state, look at both itemizing versus standard deduction. There may be times where that is beneficial. So let's dive into that last bullet here, itemized deductions. Right? Couple of big things right here. One of the things that was debated a lot was this exclusion of Section 199A. We'll get into that, right? That's the deduction for pass-through, right? Qualified business income. If you're a pass-through entity, S corporation, LLC, partnership, right? That was something that they had been debating, right? If we're going to get this through and we're going to make it revenue neutral, is that something that we have to put a cap on? Is that something that we have to get rid of? And that was explicitly excluded. And so that's really good. There have been some small changes to the way that if you're in the top tax bracket, to the way your deduction is calculated. It's now $1 as opposed to a percentage. That's something we're not going to go into, but something just to know so that when you're looking at this with your accountants. And then this last point is a really big one, especially if we're looking at workforce, right? Retention has been a huge thing. Recruiting has been a huge thing in this industry. Well, at least during the term of this administration, there's a deduction now for overtime pay, right? So folks can now deduct up to $12,500 as an individual, $25,000 as a joint filer for this overtime pay. That could be huge, right? This goes all the way up to $150,000 in adjusted gross income for individuals, $300,000 for joint filers. And this is also available to non-itemizers, right? You do not have to itemize your deductions to be able to take a deduction for this overtime pay. So thinking about folks in your organization, ways that you can help them, ways that you can provide some type of incentive there, this could be a big one, right? If folks are working overtime can get a deduction for that work, that's big, right? That could save people some real money, and that real money matters right now. And so just a good thing for you to keep in the back of your mind for your rank and file employees here. So again, We encourage everybody, always run those calculations side by side, standard versus itemized, particularly if you had a year where there were certain expenses like medical expenses that were higher, right? So something happened, there were procedures, testing, whatever it is. Run those calculations, have the CPA run the calculations. And then, of course, as always, discuss those charitable contributions with the CPA. When do you use them, right? Do you do them through the business? Do you do them as an individual? Where are you going to get your most bang for your buck from a tax perspective? So thinking through this, especially for folks who sit in an owner role, we want to be thinking both business and personal because those are intertwined. How are we going to marry those up, right? And how are we going to make the most sense so we can keep the most money in our pocket? All right, so let's talk a little bit about this. This was a big one, right? If nothing had changed, right? If the law had not changed, as of January 1st of this year, 2026, that estate tax exemption would have been cut in half. Right, so instead of this 15 and 30 you see here, it would be 7.5 million over your lifetime for an individual, 15 million for a married couple. So that's big. That's real dollars right there. And when you're thinking about estate planning, if you're an owner sitting here thinking, how am I going to protect net worth? How am I going to get this money to the next generation? How are we going to create some intergenerational wealth and save on taxes? Well, knowing that we have this large exemption is really, really important because this allows us to do things like gifting over a lifetime, to transition ownership, to move some money, assets out of our estate to the next generation. That at 15 million for a married couple, we're running up against that pretty quickly, especially when we talk about dealers who own both land, real estate, and the business, right? In many cases, that land is probably worth more, but we're really looking here at, at $8 to $10 million of land. Well, you only have $5 to $7 million of business value at that point, and then you would be bumping up against that old limit. This 30 million gives us a lot more flexibility. All right, and as we can see here, it's going to adjust for inflation. The important thing here is that we're not saying that this can't be reversed, but there was no expiration date included. And that's important because that gives us more clarity around planning. And everything that I've read, all of the IRS publications that have come out, if you are operating under this current law and at some point in the future, they were to reduce this exemption, as long as you're operating under the rules then, we should be fine. And so if they were to cut it in half and you were to give 25 million, that's okay. Right, we're going to be okay there. So I think it's important to have a little bit more clarity because some of these things like the overtime pay that are temporary can be challenging, right? It's challenging to plan for something that then may go away, but then may not go away. It makes planning very difficult. So what can we do now? Got to know the value of your liquid assets, right? Business, real estate in particular. And you really need to get these valued on an ongoing basis. I know one of the things we do with a lot of our clients here is once we have valued their business, a lot of times we will build them a model, right? It will become part of their stockholders agreement, and they'll have in there what's called a certification of value. It's not going to work for gift tax purposes. It's not going to work if for a buyout. But what it does is it at least gives you an idea of where the business sits value-wise every year. This becomes really important in planning because you can tell whether that business is approaching this 15 or $30 million limit. And to think about it in terms of, let's say you did own, and we've got many clients like this. Let's say we've got 15 million of real estate and the business is worth 10 million. That's $25 million right there that if the couple were to die, we wouldn't have to pay any estate taxes. However, if we run that and say the business and the real estate are going to increase 10 to 15% a year, but we're going to be only increasing this exemption by 1 to 2% a year, within 5 or 6 years, all of a sudden, we're going to have a taxable estate. And that doesn't even factor into all of the other things that could be in there: retirement accounts, brokerage accounts, properties outside of the business, vacation, primary residence. So thinking about this stuff ahead of time and understanding how we use discounts, especially in the valuation of the liquid assets, to legally reduce value can be a really, really good way for you to long-term plan to protect those assets. So with that, I think is a good time. We'll take a quick pause here and just see what are folks doing right now with your estate planning. Have you talked to your attorney since these new rules were written? Have you had a discussion? Are you actively doing something, or are you just looking to learn some more? And again, this will be in the chat, so appreciate folks. Perfect. Perfect. Yeah, thank you guys for responding. Sort of a mixed bag. Estate planning can be a little bit more difficult and a little bit less certain than your year-to-year tax planning, but certainly something that we need to consider. And I'm glad that a few folks are starting to have those conversations, because it is important and it tends to snowball over time. So let's get to this, the last couple points we wanted to talk about here. Qualified business income deduction, right? It remains at 20% and there's no expiration date. Again, can this be reversed? Absolutely, but it would have to take a new act of Congress. That no expiration gives us some certainty, which is good. We just have to remember, and this is all part of the planning, that those deductions are going to phase out at higher incomes. And that's where we really need to think, as we talked about up top, where S corporation, partnership, are there ways that you can reduce that taxable income? And it could be putting new equipment into service. Compensation, right? Compensation, and a lot of times can play into these QBI calculations. So review that compensation structure. What are you bonusing versus what are you putting into retirement? Cash benefit can again come up here. So thinking about that, looking at your entity structure, right? C corporation obviously can't take this QBI. That's one of the reasons it was originally written into the 2017 tax laws, because when they lowered the corporate tax rate for C corporations, they didn't want to be unfair to the pass-through entities. So comparing, right? If you're a C corporation, does it make sense to become an S? Are there reasons to stay a C, right? Maybe you're avoiding some franchise tax by being a C corporation. So all of this becomes part of that tax planning that you can do with your accountant. And then again, just coming up with anything, right? These above the line, minimize above the line income, right? So we improve opportunities to use QBI. This is a discussion for you and your accountant to have, but especially if you have pass-through entity, right? This is something that you're going to need to think about both from the business and from the personal side. All right, these were some big ones, right? Especially in this industry, these were really, really big adjustments, amendments. Remember, in the original 2018 tax bill, we started off with 100% allowance for this accelerated bonus depreciation, but then it started to phase out, and it was going to be at only 40% in 2025 until they passed this bill. That's why they retroactively went back to January. Okay. Two different sections of the tax code here. The section 168 is depreciation, right? We are recouping our investment in something by depreciating it over time. Section 179, that is a straight expense, right? We can expense property, right? And then there's a phase out threshold. We get every dollar up to 2.5 million, and there's a phase out between there and 4 million. So it's really a strategy that you need to use to figure out, what did I just put in place, right? And 168 versus 179, whether you're doing depreciation or expensing, is going to matter what you put in service, right? So if we are putting into service some type of property improvement, a lot of times that's better for 179, right? That would be something that you can do there that may not have as much bang for your buck on the section 168. 168, really good for your shorter lived types of things, forklifts, trucks, computers, office furniture, things like that, racking, those types of things typically work better under 168. The other thing we have to really think about here is depending on the size of your operation and the investments that you're looking to make, 179 has a cap, right, at 4 million. Above that, the expensing, you're not going to get any more benefit from the expensing. There's no phase out limit on 168, right? We could put $10 million of equipment into production, right? And so this is where you need to be strategic of how you're doing this. But remember, one of the things to remember when we are looking to make investments, yes, it's an outlay of cash flow. Yes, we can use it to help control taxes. But from a business valuation standpoint, those are what we call non-recurring. Those are add backs. And if I have to make $100,000 just to put a new software system in place, and then maybe I'm paying $20,000 a year or $40,000 of ongoing service and maintenance fees, that $100,000 cost can get added back, right? That's $100,000 that directly impacts your net cash flow, which directly goes to value, right? If I'm working off a 5 times multiple and I can add $100,000 back, that's $500,000 you just increased the value of your business. And so these are really, really good tools to use both to control taxes, but also understanding that that investment that you're making is something that can be backed out and will help the overall value of the business down the line. So down to the last two things here. This part is important for all of us to remember, right? This is about the low income housing tax credit, right? So this bill did a couple things here, right? It increases and it permanently, or at least without, any type of windfall or end date, I should say, increased each state's annual allocation ceiling by about 12%. And this is good because now these state agencies are going to have substantially more funding to award to high demand affordable housing projects, right? So depending on where you're sitting, some of your customers could be getting into this. It's also going to lower this, what's called private activity bond, PAB threshold, right? This essentially what this does is it allows folks in the contractors, right, your customers, to be able to put up less of their own capital to get projects started. And that's kind of the goal, is if we can incentivize folks to build more, that is good for our housing market. That is good for our country. This folks have said it could lead to 1 million more affordable homes. Those are projections. We don't know about that. But one of the important things here is that what we're trying to do here, and this road to housing bill that is hopefully will become law soon, is just to free up, to break some of this logjam, to get more homes built. And if we're in the business of selling products to people who are building homes, we want them to know about this, right? We want them to know about some of the opportunities out there. Local chambers of commerce, local housing authorities, these are good people to get in touch with. Find out what you can do to help them to market these. Hey, I'm a dealer. I work with a number of contracting builder customers. How can I help you guys get the word out there? What programs, what advantages do you have for my customers? If you can figure out how to make your customers more money, stick your relationships. They're going to bring you more business, increase net cash flow. All of that goes into the ultimate value of your business and the profitability of your business. So last thing we'll touch on here, and then we'll open it up to some Q&A, is this idea of these savings accounts for minors, what have been called Trump accounts, right? And the idea here is to try to give folks another savings vehicle, right, that is outside opening a Roth IRA for your kid or opening a uniform gift to minor account. And these work very similar to IRA accounts in that you can put money away in them. They cannot be touched by the beneficiary until they hit age 18, right? At age 18, the account gets retitled, and then it can be used for lots of different things. Now, the interesting thing here is, as we're talking about recruiting and retention and how do we help this, employers can make contributions. Employers can make contributions of up to $2,500 to these accounts, right? And they can take a deduction for that. That's an expense. It does not count as a taxable event to the employee. It can be taken as a deduction for the employer. So win-win here that can really, really help us as a business create another benefit for our employees. So just like we have the overtime rules, we now have this potential for the Trump account. And remember, a Trump account, just like an IRA, is owned by the individual. This is not another benefit that you as a company have to manage, right? This is not like health insurance. This is not like 401k. This is something that if your employees who are of childbearing age, who have children, want to do for their kids, this is another benefit you can think about providing them that does not require your maintenance and oversight, because the account is their responsibility, just like an IRA. All right. And down the line, these accounts can be used for all different kinds of things. Unlike a 529, which is just for educational expenses, this can be used for all different kinds of things. Home ownership being a big one, right? As we're seeing that age of first-time home ownership creep up, giving some money to folks could be a really good way to do this. So think this through, think about how it might help in your company, and just bringing this up, talking about this with an all hands on deck meeting. Hey, we've got some updates for you. Could be a really nice way to get people thinking about this. So be proactive, right? Meet with your accountant. I would encourage everybody to get an updated appraisal, right, of the business and the real estate, especially if you have not gotten one in the last 3 or 4 years. They have both gone up in quite a bit in value, would be my guess. Make sure your employees know about some of these tax benefits. Right? We talked about overtime pay and Trump accounts. I think those are going to be really, really important. Those are things that they can easily do. And those are things that you can bring value to them, make that sticky relationship, make the employee go, boy, this company is great to work for. And then work with those customers, have them understand how they can reduce their tax bill, how they can make more money, right? We put more money in folks' pockets. That's a good thing for all of us. So thank you, everybody. We're going to turn it over for questions in a second. If people have questions or comments or want to talk to us offline, absolutely give us a call. And we do everything from valuations to developing and implementing these succession plans, getting everything, all your ducks in a row. So we appreciate your time. And with that, I will leave it on the contact information. Cody, fire away.
Perfect, Sam. Thank you very much. We will give it just a couple of minutes here if anybody is typing a question in. Sam, talk a little bit more about the overtime tax exemption and ultimately how does that impact us as business owners and ultimately for the employees as well. I think there's some confusion out there on this whole overtime tax exemption thing.
Yeah, and so part of it is as the business owner just deciding, is overtime something, how much do you want to actually provide or give folks the opportunity for overtime, right? Because that ultimately is a cost for the business to do that, right? Is more pay, right? We're typically paying a higher hourly rate. But the deduction itself can be really, really helpful because most of the folks that we have that are working for us in our yard, for example, in a mill shop, are people that are going to be under those thresholds, 150 million or 150,000 for an individual, 300,000 for joint filers. And so this is something that they can take advantage of right now for the next 4 years, right? Or for the next 4 filing periods if they haven't filed in 25 yet. And this is a way that they can put more money in their pocket. They can feel good about the effort that they're expending. And it just feels like when I'm putting in a little bit more work for this company, I'm getting a benefit. And a lot of folks will not know about this, right? If you're talking rank and file employees, they're probably not using an accountant. They may be doing it themselves. But this is something that I would encourage you as an owner or a leader to talk to your folks about, because taking a $25,000 deduction for up to, I should say, $25,000 deduction for a family, could make a big difference, right? In terms of they can go on an extra vacation, they can provide some money to the school or the church or whatever the case may be. So I do think that there are benefits, and it's a defined period of time, at least for now. And so it would behoove us to at least have those conversations with our employees, because it's not gonna be here forever unless there's Congress comes in and changes this in 2028.
Perfect. Well, Sam, with that, we're going to go ahead and close this thing out. Once again, thank you very much for sharing your expertise and breaking down these important tax updates in a very clear and actionable way. We really appreciate the insights and the connection you made between the tax strategy and long-term business value. Thank you again to all of our attendees for taking the time to join us today. We know your schedules are extremely busy this time of year, and we're so glad you took the few minutes here to come and join us. We hope you're leaving with a stronger understanding of how the tax changes can impact your cash flow and your valuation, and more importantly, a clear set of next steps you can put in action right away to support growth and strengthen your business and your own personal wealth for the future. We also extend our appreciation once again to our friends at LBM Advantage for sponsoring this webinar series and our entire summer webinar series. Sam and your team over at Stratus, thank you all very much for your time, and everybody have a wonderful afternoon.
Our pleasure. Thanks, Cody. Take care, everybody.